Silver just broke past $60 an ounce for the first time ever, so why is Ray Dalio still betting big on gold instead? The billionaire hedge fund manager has been crystal clear about his metal preference, and the reasons go way deeper than most people realize. With silver rallying harder than gold in recent months, investors are asking themselves if they're backing the wrong precious metal. Ray Dalio has been one of the loudest voices pushing investors to put gold in their portfolios. Not 2%, not 5%, he's talking about 15% of an entire portfolio. That's massive compared to what most financial advisors suggest. But here's the thing that catches people off guard. Silver has been absolutely destroying it lately. The white metal hit record highs. Industrial demand is through the roof, and some investors are making the case that silver is the smarter play right now. So what does Dalio know that others might be missing? And more importantly, what happened in the 1970s that changed his entire view on precious metals forever? Let's start with the foundation of Dalio's thinking. At the World Economic Forum in Davos. Just a few days ago, Dalio laid out something really interesting. He said gold isn't just a precious metal that randomly goes up. When gold jumped 67% in 2025, it wasn't because people suddenly thought it looked pretty. Central banks around the world were buying it up like crazy. They were diversifying away from fiat currencies, especially the dollar. Dalio explained that gold is the only asset where someone doesn't have to depend on anybody else to pay them money for it. Think about that for a second. If someone holds a bond, they're depending on a government to pay them back. If someone holds a stock, they're depending on a company to perform well. But gold just exists. It has value because thousands of years of human history say it does. Here's a story that really drives this home. In 2008, during the financial crisis, Dalio watched as major investment banks collapsed overnight. Bear Stearns, gone. Lehman Brothers, wiped out. These were institutions that everyone thought were too big to fail. People who held their bonds thought they had safe investments. They were wrong, but the people who held gold, they were fine. Actually, they were more than fine. While everything else was crashing, gold was holding its value. Dalio calls this the ultimate insurance policy. When things go wrong with debt, when governments print too much money, when trust in paper currencies breaks down, gold does well, really well. Silver doesn't have this same role in the global financial system. Sure, silver has been used as currency before, but it's not what central banks are stockpiling. It's not what countries turn to when they're worried about their debt levels. Gold holds this unique position that silver simply doesn't occupy. But here's where it gets interesting. There's one specific reason why silver can never play this role, and it has to do with what happened to a major economy in the 1980s. Dalio addressed this directly on social media. When someone asked him why not silver or platinum, his answer was pretty straightforward. Silver is way more influenced by industrial demand, and this leads to much greater price volatility. Let's break down what this means in real terms. Think of it like this. Gold is like a deep ocean. When storms hit the surface, the deep water barely moves. Silver is like a shallow pond. When the same storm hits, the entire pond gets churned up. The shallow depth means every disturbance creates massive waves. Silver is used in solar panels, electronics, medical equipment, and tons of other industrial applications. This is actually a good thing in many ways. It means silver has real utility beyond just being a store of value. But here's the catch. When the economy slows down, industrial demand drops. When industrial demand drops, silver prices can fall fast, really fast. There's a perfect example of this from 2011. Silver hit nearly $50 an ounce that year. Investors were going crazy for it. People were predicting it would go to $100, even $200. Then industrial demand started softening as the global economy slowed. Within months, silver crashed back down to $26. It lost almost half its value. People who thought they were making smart investments got absolutely crushed. Gold during that same period, it stayed relatively stable, only dropping about 20% before recovering. Gold doesn't have this problem to the same degree. Sure, gold gets used in some industrial applications and jewelry, but its primary role is as a monetary asset and a store of wealth. This makes gold more stable during economic turmoil, and stability is exactly what Dalio is looking for. He's not trying to make a quick buck on a hot trade. He's trying to protect wealth over the long term. When Dalio talks about gold making up 15% of a portfolio, he's thinking about what happens during a crisis. During the 2008 financial crisis, gold held up. During periods of high inflation in the 1970s, gold went up. During the recent chaos, with government debt levels exploding, gold hit all-time highs. Silver can have explosive moves upward, absolutely, but it can also have brutal moves downward when industrial demand dries up. For someone like Dalio, who studies 500 years of economic history, that volatility is a bug, not a feature. And speaking of history, there's a moment from Dalio's own past that reveals why he's so obsessed with studying these patterns. Dalio really hammered this point home in his recent statements. Gold occupies a unique place in the portfolios of investors and central banks because it's the most universally accepted non-fiat currency-based medium of exchange. Let's think about what this means practically. Here's something most people don't know. In 1982, Dalio made one of the biggest mistakes of his career. He predicted a massive depression was coming. He was so confident that he bet everything on it. He went on TV, he wrote articles, he told everyone who would listen, and he was completely wrong. The economy didn't collapse. It boomed. His fund lost so much money that he had to let everyone go. He was so broke that he had to borrow $4,000 from his dad just to pay bills. That failure taught Dalio something crucial. He couldn't just rely on his own opinions or short-term predictions. He needed to study history. He needed to look at what actually worked over centuries, not just years. That's when he started diving deep into the past 500 years of economic cycles. And what he found was that gold was the one constant. If someone is sitting in Japan, China, Europe, the Middle East, South America, or anywhere else in the world, they recognize gold as valuable. It doesn't matter what their local currency is doing. It doesn't matter what their government's debt situation looks like. Gold is gold everywhere. Central banks hold gold as part of their reserves. According to the latest data, central banks have been buying gold at rates not seen in decades. They're not doing this with silver. They're doing it with gold. Why? Because when things get really bad, when trust breaks down between nations, when currency wars turn into capital wars, as Dalio calls them, gold is what everyone agrees on. Silver doesn't have this same universal acceptance. Dalio pointed out that while silver and platinum share some similarities with gold in terms of industrial applications, they don't possess the same level of historical and cultural significance as a store of value. This isn't just about the past. This is about what happens in the future when the next crisis hits. Will silver be accepted as readily as gold? History suggests no, but the real question is this. If gold is so universally accepted, why are countries suddenly buying it at such an alarming rate right now? What do they know that regular investors don't? Dalio has been warning about the United States debt situation for years now. The country is sitting on $38 trillion in national debt. That number is insane. To put it in perspective, that's more than the entire economy produces in a year. Dalio says if the US doesn't cut the deficit to 3% of GDP soon, there's a risk of an economic heart attack in the next 3 years. These aren't just random predictions. Dalio has studied what happens when countries get into this situation. He looked at the past 500 years of economic history and found the same patterns repeating over and over again. When debt accumulates faster than income, governments face a choice. They can confront a potentially severe debt crisis, or they can print more money. Guess which one they usually choose? They print more money. Always have, always will. And when governments print more money, the value of that money goes down. This is where gold shines. Unlike paper currency, nobody can just create more gold out of thin air. The supply is limited. Mining output is relatively stable. This is why Dalio calls gold the second largest reserve currency in the world. There's a historical example that perfectly captures what Dalio is worried about. In 1923, Germany was drowning in debt from World War I. The government decided to print money to pay off its obligations. At first, it seemed to work, but then things spiraled out of control. By November 1923, A loaf of bread that cost 250 marks in January was selling for 200 billion marks. People needed wheelbarrows full of cash just to buy groceries. Life savings became worthless overnight. But here's the crazy part. People who had gold were fine. While paper money became worthless, gold held its value. A single gold coin could buy what stacks of paper currency couldn't. That's the kind of scenario Dalio is preparing for. Not necessarily hyperinflation like Weimar Germany, but a significant loss of purchasing power in paper currencies. Silver does provide some protection against currency devaluation too, but here's the key difference. When we're talking about a potential breakdown of the monetary order, which is exactly what Dalio warned about at Davos, gold is what the big players turn to. Central banks, sovereign wealth funds, major institutions. They're buying gold, not silver. And this brings up something really important. If Dalio is right about this debt crisis, there's one specific year in history that shows exactly what happens next. That year might shock most people. Dalio wrote an article in Time magazine where he laid out gold's track record of having its value track the cost of living. He went deep into history here since 1971. When President Nixon broke the dollar's link to gold, governments have consistently chosen to print money rather than allow debt crises to play out naturally. After more than 50 years of this, we're now seeing what Dalio calls a breakdown of the monetary order. This is huge. Look at what happened in 2025. Gold outperformed the S&P 500 by 47%. It outperformed technology stocks. It outperformed basically everything. And this wasn't because of industrial demand. This was because central banks and sophisticated investors saw what was coming. They saw rising debt, weakening trust in fiat currencies, and geopolitical tensions. They bought gold. Silver had a great year too, no question, but silver's performance was driven more by industrial demand and speculation. When Dalio looks at periods like the early 1970s, he sees similarities to today. Back then, there was a surge in inflation, massive government spending, and growing government debt. Trust in paper currency eroded. Gold went up massively during that period. Here's a specific example. In 1971, gold was $35 per ounce. By 1980, it hit $850. That's a 2,300% increase in less than a decade. Silver also went up during that time, jumping from about $1.50 to $50. That sounds amazing, right? But here's what most people don't talk about. After 1980, silver crashed hard and didn't reach $50 again for 31 years. Gold, while it also pulled back, maintained much more of its value and continued to be accumulated by central banks worldwide. Silver was much more volatile and much more dependent on industrial demand cycles. Dalio isn't trying to catch the next hot trade. He's trying to preserve purchasing power over decades, and gold has the track record to back up that strategy in a way silver doesn't. The difference between gold and silver during these periods reveals something fascinating about human psychology and why certain assets become money while others don't. But there's an even bigger issue brewing right now that most investors are completely missing. This is where Dalio's thinking gets really interesting. At Davos 2026, he warned about something he calls capital wars. Everyone's focused on trade wars and tariffs, but Dalio says the real issue is what happens with capital flows. Countries holding large amounts of US dollars and treasury bonds are getting nervous. They're looking at the debt situation and thinking maybe they don't want to finance US deficits anymore. So what are they doing? They're buying gold. Dalio said when conflicts arise, even allies don't want to hold each other's debt. They prefer to go to a hard currency, and gold is the hardest currency there is. This is logical and factual, and it's repeated throughout world history according to Dalio. Now, silver doesn't play a role in these capital wars. It's not what central banks use to diversify away from dollars. It's not what countries buy when they're worried about geopolitical tensions. Silver is a commodity with industrial uses. Gold is money. There's a fundamental difference there. Here's a real example of this playing out right now. China has been quietly reducing its holdings of US Treasury bonds over the past few years. At the same time, the Chinese central bank has been buying gold aggressively. They're not alone. Russia, Turkey, India, and dozens of other countries have been doing the same thing. This isn't a coincidence. These countries are preparing for a world where the dollar isn't the dominant reserve currency anymore. When Dalio talks about the rules-based global order breaking down, when he warns that we're in a period similar to the 1930s and 1940s in terms of great power conflicts, gold is his hedge. Silver doesn't offer the same protection. At Davos, Dalio made it clear that the monetary order is breaking down right now, not in some distant future. Central banks are shifting their holdings away from fiat currencies and debt toward hard assets like gold. Ken Griffin, the CEO of Citadel, actually called Dalio's warnings about gold concerning. Griffin said the spike in gold prices signals that investors are moving risk out of the US. But Dalio isn't fazed by criticism. He's seen these cycles before. He knows what happens when trust breaks down between nations. Gold becomes the universal language of value. So here's the bottom line that Dalio keeps coming back to. Gold isn't just a commodity or a trade. It's a monetary asset that protects wealth when the system breaks down, and that breakdown is happening right now. Ray Dalio's preference for gold over silver comes down to 6 key reasons that all connect to one central theme: protection during chaos. First, gold serves as the ultimate insurance policy that doesn't depend on anyone else's promise. When banks fail and companies collapse, gold remains. Second, silver's industrial demand creates volatility that gold avoids, the shallow pond versus deep ocean. One gets churned up by every storm, the other stays calm. Third, gold has universal acceptance among central banks and nations worldwide. This isn't opinion, it's historical fact spanning centuries. Fourth, the debt crisis is creating exactly the conditions where gold thrives. With $38 trillion in US debt and governments choosing to print money rather than face reality, the stage is set for major currency devaluation. Fifth, gold's historical track record during periods of monetary chaos is unmatched. From Weimar Germany to the 1970s inflation crisis, gold protected wealth while paper currencies failed. And sixth, the coming capital wars are driving countries toward gold, not silver. China, Russia, and dozens of other nations are quietly preparing for a world where the dollar isn't king. Does this mean silver is a bad investment? Not necessarily. Silver can absolutely have explosive moves upward, especially when industrial demand is strong and investors pile in chasing momentum. But Dalio isn't looking for explosive moves. He's looking for stability and preservation of purchasing power during what he sees as a breakdown of the monetary order. The reality is that silver and gold serve different purposes. Silver is more of a hybrid between an industrial commodity and a monetary metal. Gold is pure money in its most basic form. For someone like Dalio, who is worried about massive government debt, potential currency devaluation, and geopolitical tensions, gold is the obvious choice. It's what central banks are buying. It's what has worked for thousands of years, and it's what will likely continue to work when the next crisis hits. The silver rally is impressive. $60 an ounce is no joke, and the people who rode that wave up made serious money. But Dalio is playing a different game entirely. He's not trying to ride short-term momentum or catch the next hot commodity play. He's trying to protect wealth through what could be one of the most turbulent periods in modern economic history. And for that job, he wants gold, the metal that survived the fall of Rome, the metal that maintained value through world wars and depressions, the metal that central banks trust when everything else fails. Dalio's painful lesson in 1982, when he lost everything betting on a prediction, taught him to stop trying to outsmart markets with short-term calls. Instead, he learned to align with what works over centuries. That's gold, not because it's exciting or because it might double next year, but because when the monetary system faces its next crisis, gold will do what it's always done: survive.